You need to be familiar with the major components of the statement of retained earnings. Retained earnings is an essential part of a company's financial statements. It acts as a link between the income statement and the balance sheet. And for publicly traded companies, presenting a statement of retained earnings is a regulatory requirement. What about for a non-public company? No, it's optional. But for public companies, got to have a statement of retained earnings as part of a complete set of financial statements. So the statement of retained earnings consists of beginning retained earnings, which includes possibly changes for any prior period adjustments net of tax. Then there's net income or loss on the statement of retained earnings, and then there's a reduction for any dividends. The simplest statement of retained earnings could look like this, where you just have the beginning balance, then the net income minus the dividends, and then the ending balance. Now, why is this so basic? Because there's no adjustments for any beginning retained earnings issues, like a prior period adjustment, correction of an error, or cumulative effect of a change in accounting principle. Nothing like that going on in this statement of retained earnings for Mama T's homemade desserts. But what about for Eichmann Corp? Here's a statement of retained earnings for the year ended December 31st, 2023. Starts with the beginning balance, January 1st, 2023, as previously reported, $500,000, but then right away a prior period adjustment, which decreases the beginning balance of retained earnings by $30,000, and then the adjusted retained earnings beginning balance is $470,000 as a result of the prior period adjustment. Now from here, it's pretty much what we just saw. The net income for the year, which is after tax, $150,000. Then dividends declared and paid, subtract that, and you get your ending retained earnings balance. And then there would be a footnote which talks about the prior period adjustment. It would say the company initially reported $500,000 as the beginning balance of retained earnings, but then a prior period adjustment of $30,000 was made, which was due to an error in financial reporting in a previous year. Maybe there was an understatement of expense in the previous year that was identified and corrected in the current year. And the treatment of that is not to change the current year income statement, right? But instead to make an adjustment to the beginning balance of retained earnings for the earliest period presented. And if this is the only period presented, we're going to adjust the beginning retained earnings balance for this year. So the adjusted opening balance of retained earnings became $470,000 after this correction of the error. Let's try this question. The major components of the statement of retained earnings for a period are what? What are the major components to the statement of retained earnings? Is it A, dividends? Yeah. Prior period adjustments? Yeah. And expenses? No, expenses go on the income statement. B, income before taxes and discontinued operations? No, those both go on the income statement. The retained earnings statement will have income after tax. C, income before taxes and total assets? No, income before taxes, that's an income statement item. Total assets go on the balance sheet. D, prior period adjustments, net income after tax, and dividends, yes. Letter D is correct. The statement of retained earnings consists of beginning retained earnings adjusted for any prior period adjustments, then net income after tax or net loss, and then dividends. The final figure being ending retained earnings for the period. A is wrong, expenses are part of the income statement. B is wrong, income after tax will be reported on the statement of retained earnings, not income before tax. And C is wrong, total assets are on the balance sheet, not the statement of retained earnings. Which of the following is typically found on the statement of retained earnings? Would it be long-term debt? No, that's a liability. It would be on the balance sheet. B, inventory levels. Inventory is an asset, so that'll be on the balance sheet. C, accounts receivable, another asset, that's on the balance sheet. D, corrections of errors made in prior periods. Yes. Letter D is correct. The statement of retained earnings includes adjustments for any corrections of errors that were made in prior periods, as these corrections affect the beginning retained earnings balance. The retained earnings statement does not include long-term debt, inventory levels, or accounts receivable because those are found on the balance sheet. All right, how does a net loss for the period affect the statement of retained earnings? It wouldn't increase retained earnings. It would decrease retained earnings. C would be wrong. It wouldn't be a transfer to additional paid-in capital. Letter B is correct. When a company experiences a net loss, This amount is subtracted from the retained earnings, leading to a decrease in the retained earnings balance. This is because retained earnings represent the accumulated profits after dividends, and the net loss reduces this accumulated amount. All right, in addition to the statement of retained earnings, where else does the ending balance of retained earnings appear? And if you think you know, leave me the answer in the comments section. And remember to like and subscribe because it helps the channel out a lot. And if you need more help with FAR or any one of the CPA exams, go to i75cpareview.com. Get yourself on I-75 with me, Darius Clark, because the right teacher makes all the difference. If you're on the site right now, click on CPA Review and then FAR, and then you can choose between the full course FAR monthly subscription option or the 15-day FAR cram. With the monthly subscription option, you can cancel anytime. You can email me and I'll cancel for you personally. Or you can check out one of our specials, like the one we have right here. Go to i75cpareview.com and get yourself on the right road to passing the CPA exam.